To introduce Mr. E. A. Sundaram. Uh, as Mahalakshmi was saying, Mr. Bhattacharya is one original great. So we move from one OG to another OG in the room. Uh, Mr. E. A. Sundaram, he is Executive Director and CIO Public Markets at O3 Capital. He's a veteran investor with more than 33 years experience in the markets. I don't know how many of you know, he began his career in 1989. He was the first person to be hired in the research department of SBI Mutual Fund. And SBI Mutual Fund, again, some of you may not know, was the first non-UTI mutual fund in the country. So in a way, he started the buy-side industry, so to speak, in India. After SBI, he has worked with some of the most prestigious investment firms in the country, including Zurich Mutual Fund, HDFC Mutual Fund, M3 Investment Managers, and PGIM Mutual Fund. He's a contrarian investor by nature who's not afraid to go against the crowd and invest in unpopular stocks and sectors. His approach has served him very well. His track record shows that. And he has been able to avoid many of the market pitfalls. For example, he was underweight technology stocks in 1999 when the dot-com burst happened, and the bubble was at peak before that. He was also underweight infrastructure stocks, utilities, and power stocks in 2007, just before the global financial crisis. And he also was underweight mid-cap stocks in 2017 when they were trading at very expensive valuations. His contrarian approach has helped him to protect his investors' capital and generate consistent returns over a long term. He has a very clear investment philosophy and process which he sticks to even in the most difficult times. He believes investing in businesses and with long track records of high return on capital, but at the same time, and he's not willing to overpay for such businesses. He's a true value investor, patient, disciplined, and contrarian. His investment style, I would say, is very akin to, if we talk in cricket parlance, to Rahul Dravid, who's one of the greatest test batsmen of all time. And we all, when we are value investors, we compare investing to not one days, but test matches. Dravid, when he was playing test cricket, he was known for his patience, discipline, and ability to stay focused even in most difficult conditions. And hence I say that Sundaram is the Dravid of Indian investment markets. He was also, just like Dravid, he's also the master of the art of leaving the ball, so to speak, which is very, very essential for survival in test cricket as well as investing. Sundaram's approach is very similar to this, which Rahul Dravid adopts. He's willing to wait for the right opportunities to come to him, and he's not afraid to pass on investments that he does not believe in. He's very disciplined in his risk management and takes steps to protect his capital from downside risks. So, with this, let me not take more time. Please join me in welcoming Mr. E. A. Sundaram.
I'm very happy to be here, ladies and gentlemen, at this CFA Value Investors Conference.
Somebody will do.
I wish to thank the CFA Society and the office bearers and Jitendra Chala for his very, effusive praise of myself. I'm also honored to share the dais with three of the people I admire and respect a lot in the investment field. I've had the privilege of working in Sanjay Bhattacharya's team several years ago at HDFC Asset Management Company. And the team which worked with him at that time, even today, he is a guide and mentor for all of us. I've admired Professor Sanjay Bakshi for his erudition and his thoughtful presentations. And it's been a delight to watch Shyam Shekhar's video blogs, which he does in Tamil language, in simple conversational Tamil without any jargon, how he explains investment concepts to viewers. So I am very happy to be part of this great set of speakers. This is what I intend to speak about today. I think just as in everything else in life, in managing a portfolio also, achieving a balance is very important. And I'll speak a little more about it in later slides. What prompted this presentation, and indeed what has prompted this thinking for me as a portfolio manager, has been two quotes from two great investors. I'll just read them out to you. You will be much more in control if you realize how much you are not in control. This quote is by Benjamin Graham. I want you to ponder over it for a few seconds. This is fraught with so much important meanings. You will be much more in control if you realize how much you are not in control. When you realize you are not in control, the tendency is not to take unnecessary risks, and that gives a balance to the portfolio. The second one, which is by Seth Klarman, a successful investor must possess a number of seemingly contradictory qualities. These include the arrogance to act and act decisively, and the humility to know that you could be wrong. Again, this talks of balance. We have to stay away from the crowd. We have to have the conviction to act and act decisively going against the crowd, but with the full knowledge that we could be wrong. I think these are two beautiful sayings which will help us achieve a great deal of balance in our portfolio. The premise with which I am operating and the premise with which I am approaching this presentation is this. The portfolio benefits when there is a proper balance between the desire to be proven right and the reality check that we may not be. I think we are exposed to this in many ways. In other cultures also, for example, in the Chinese culture, there is this talk of yin and yang. In our own culture, there is this talk of Ida and Pingala, which is, and scientists also talk about the right side of the brain and the left side of the brain, one controlling reason, logic, and intellect, and the other one controlling the aesthetics and artistic side and intuition and humor and so on and so forth. Neither side is more important than the other, but both are essential for maintaining a good balance in life, and therefore also in the portfolio. Let's begin by looking at some of the where the bulk of the conversation lies, not just in the mainstream media, but also in everyday evening conversations about the stock market. Which stock will go up? When will it go up? Which sectors are good for investments? Should I invest in large cap, mid cap, or small cap? And which will do better? And of course, this being the election season, there is talk about which party will win the maximum number of seats in the election and so on and so forth, and try to adjust the portfolio accordingly. Where will be the rupee-dollar rate? When will interest rates peak out? How do we solve the Ukraine war? And so many other things. And all of them, which is what I would classify as external factors in investing. See, and this has been fueled by social media. The social media things have turned most of us into virologists 3 years ago. Then we became strategic affairs experts about 2 years ago. And more recently, we have turned into cephologists. But these are the popular external factors which people generally talk about. Macroeconomic factors, political and geopolitical factors, competitive landscape of an industry or a business, company-specific factors, fund flow, FII flows and mutual fund flows and so on and so forth, valuation, which is really a function of what others think about the stock. While all of these are important, I am not dismissing any one of these. All of these are important. But the important thing to realize is that these are not in our control. These are never going to be in our control. So while it's important to
keep abreast of these things to the extent possible. It's also important to remember that these are not in our control. They never will be. So there is something else that is needed. And one more observation about the general stock market discussion. There is enormous focus on the intellect part of investing. And this is true whether in conversations across the country or in mainstream media conversations. There is always a focus on what I think are the external factors, which is focusing on the intellect part of investing. Very, very less attention is given to the temperament part of investing, which is, in my submission, at least as important. There is also a tendency to equate the price movement of the stock to the extent of success in investing. This is, it's an observable tendency. What I am calling for is balancing all of these with what I call internal factors. And some of them I have listed here. The things that I consider important enough I have listed here. Determining the time horizon that we are comfortable with. And it will depend upon person to person. I want to quote Morgan Housel here, who has beautifully said it. A lot of financial debates are just people with different time horizons talking over each other. What is good for me need not be good for you. And you have to figure out what is good for you. And that only with experience, with an attention to the time horizon that we are comfortable with, we can come to that conclusion. Determination of what we know and what we don't. It is extremely important. Buffett calls it the circle of competence. He has also said that it is not important how big that circle is, but we should know where that boundary lies. If I don't understand cryptocurrency, I should not attempt to invest in it. Especially, as Sanjoy pointed out, we have a fiduciary responsibility of handling somebody else's money. So we have no business in investing in something if we don't ourselves understand that business. So it's very important to draw that line of what we really know. Of course, we should make an attempt to know. But if beyond a reasonable extent of effort that we put in, if we are still unable to understand it, there is no point in acting intelligently. What we buy is important. How much of it we buy is important. And at what price we buy is important. And most important of all is our attitude towards how much money somebody else has made. Usually, this is the cause of the problem. Most people left to themselves are happy with a 16 to 17% rate of return until they find out that their neighbor has made 25. That is when the problem will start. And I am not saying that the so-called retail investor alone is subjected to this. There are several allegedly professional investors I know who simply cannot tolerate if somebody else has made more money than them. If somebody else has made more money than us in 1 year, these are the possibilities. Either he or she is a better investor. Number two, maybe they have been lucky this year. Maybe the stocks they choose this year has done better. Maybe our stocks will do better next year. But how many people have the temperament to think like that? The anxiety to be number one at all points of time leads people to make crazy mistakes and crazy errors in the portfolio. This list of internal factors that I have described to you are 100% in our control. We need not depend on anything else. It is in our control. And it is my submission to you that managing these external factors with these internal factors leads to a proper balance in the portfolio. The first step in finding this balance is to determine which external factors are important for us. There are hundreds of variables over which you and I have no control. But we have to determine which are the important factors which we want to seek in building our portfolio. Number one, and these are the 4 factors which I consider important. The others may have a different opinion. The others may have a different set of criteria. The 4 criteria that I consider important, I have listed here. the extent of competitiveness the company being studied, and a judgment about the continuance of that competitiveness. I think this is critical as far as an investor is concerned. The sustainability of that competitiveness, at least in the foreseeable future. Nobody can foresee for 10 years and beyond. But in a reasonable time horizon, if we can be confident that the company will remain competitive, that is the first step. The second step is the growth prospects offered and the ability of the company to grow. I am not interested in making EPS projections with millimetric accuracy. That is not my cup of tea. That is not my intention also. But I am interested in determining whether the company has the ability to grow. And the metric that I use is that they should not significantly lose market share. We should be confident that the company's market share will not significantly deteriorate in the years to come. I'm satisfied with that. The third is the kind of people managing the company. And the only way to judge this is to look at the track record, which is why investors like me want to look at companies that have already established a track record. I am not a venture capital investor. I am not an early stage investor. So I don't look at companies that don't have a long track record. So a long track record gives me some clues about how the management has thought, especially in terms of things like capital allocation or attitude towards minority shareholders' rights. This can only be judged by the track record. I am not good at body language based investing. So I have to look at the track record. And finally, the valuation at which the stock is available. These four I would consider as important external factors which any investor has to look at. You would have noticed that I have not listed the Ukraine war or the South China Sea problem or anything of the kind, because these are simply beyond my control. In order to achieve a balance in this is the process that we have put in place in our company. I want to spend a few minutes on this slide because I think it is a articulation of the kind of balance that we want to seek. The entire focus is on losing less money. The focus is not on maximizing returns. The focus is on losing less money. And this is a lesson learned 20 years ago. I primarily handle money for people who have copious amounts of money. That's the kind of portfolios of clients that we have. Their primary concern is not that they want to get rich. They are rich already. Their primary concern is, I have made my money the hard way. I don't want some smart aleck portfolio manager to lose it. That is their primary concern. So they are happy with a logical investment process. They are happy with a decent rate of return without subjecting their money to unnecessary levels of risk. If we can show them that process, they are happy. This is the process that we have put in place. I have divided companies into non-financials and financials. And for non-financials, these are some of the measurable indicators which I am seeking from a company. 15 years of track record. Why 15 years? Because in 15 years, any company goes through at least one full business cycle. If it has gone through a business cycle, it has gone through a difficult period. If it has gone through a difficult period, it is our belief that the management of that company would have learned something valuable during that period, which they are unlikely to have learned from IIM Ahmedabad or Harvard Business School. A difficult period is the best teacher in life. So I want companies that have been through a difficult period. And 15 years gives me the confidence that the company has been through at least one difficult period. Number two, I want a minimum scale of operations, which I have defined as 500 crores of revenue. We run a multi-cap portfolio. So I want large cap companies, I want mid-cap companies, and I want a few small cap companies also. But I am not interested in the tiny tots. These 50 crore companies or 75 crore companies, there's nothing wrong with them, but it's just that they are difficult to acquire. And more importantly, in a crunch time, they get very difficult to sell. The last thing our clients would want is to be stuck with a set of companies they are unable to sell in a bear market. And 500 crores revenue gives me that confidence that The chance of that happening are fewer. The chances of that happening are fewer. I'm not saying it is not possible at all, but it's fewer. The third and fourth parameter that we seek is consistency of high return on capital and consistency of the ability to generate free cash. Every year of return on capital, especially in the last 10 years, that is the criteria. In the last 10 years, every year in which the company has generated 20% or higher return on capital, it gets a score of 1 in our scoring system. Even if it is 19.5%, it gets 0. So it should be 20% or higher. And 20%, in my opinion, is a pretty stiff target. It's significantly higher than the cost of funds of any company. Done over 10 years, the maximum score any company can make on this parameter is 10 points. I also look for the ability of the company to generate free cash flow, which in our opinion is more important than reported net profits. Net profits can be adjusted with clever accounting, but free cash flow, you either have it or you don't. So every year of positive free cash flow gives the company a score of 1. Negative free cash flow gets the company a score of 0. Done over 10 years, the maximum score on this point also is 10 points. And if the company generates consistent free cash flow, there are two things you know about that business. The figures are more believable. And secondly, the company is living within its means. Just as in our household budget, we want to live within our means, and I would consider that a good habit to have. I also want companies to live within its means. And free cash flow tells me that the company is living within its means. Of course, once in a while, if a company borrows to fund a capex program, it's perfectly acceptable. But chronically capital-hungry companies, we will not consider. And again, I want to clarify this. This is just one way of investing. I am not claiming that this is the best method, but it's a good method. That's all that I want to stress on. If the maximum score any non-financial company can make on this parameter is 20 points, our cutoff is 14. So in order to qualify for the investment universe, a non-financial company has to be at least 15 years old. It should be at least 500 crores in revenue, and it should score at least 14 on 20 on these parameters. Then it goes into the universe. Similarly, for financial companies, we have a separate set of criteria. It should have 25 years of existence. The return on assets should be greater than 1% if it's a bank and greater than 2% if it's an NBFC.
Is it this one?
Return on equity should be greater than 15% and the net NPA should be less than 2. So if you add up all these things, to cut the long story short, a bank will have a maximum of 50-point score and an NBFC will have a maximum of 40-point score. And just as we have 14 on 20 for a non-financial company, we have 28 on 40 for an NBFC and 35 on 50 for a bank. After all of these things, these are important, but these are not sufficient. So we have only discussed the past track record of the company. After that, we have to satisfy ourselves that the future also looks good. And for that, there are a few parameters. Based on whatever research that we do, as I said in the previous slide, we should be confident that the competitive position of this company is under no existential threat, to the extent possible for us to come to the conclusion. Number two, we should be confident that the company is capable of growing its revenues and net profit substantially over the next 3 to 5 years compared to what it is today. And I want to be confident that the market share is not going to significantly go down. Third is about the management. How do you judge management? Only by the track record. And one way to judge the track record is to look at the track record of market share. If the market share has been consistently maintained or improved, it's a good sign. If the market share has been consistently going down, it's a warning sign. And we all know that the most important job of top management is to allocate capital efficiently. Look at the track record in capital allocation. Have they diversified unnecessarily? Have they destroyed return on capital? Have they routed profitable business through an unlisted private entity and not through the listed entity? What has been their dividend policy? Have they been articulate about it? Have they been consistent about it? And most importantly, during bad times, has the management been forthcoming in explaining the problems to investors? Have they been open about it? And are they as willing to meet investment community during bad times as they are during good times? These are signs that the management cares for the shareholders. course, there is no 100% guarantee in anything, but these are signs that we will look for. And finally, looking at the valuation. Now, a good company like this is available at a decent price only when it is going through a period of difficulty. When you and I can see the profits booming, so can the rest of the world. When the rest of the world is excited about that stock, it is not cheap. And when you buy when the stock is not cheap, you don't make that much money. So, I think the entire process I have outlined here, and I have also kept 20 to 25% maximum for companies that don't meet this criteria, but still I want to include in the portfolio. I have kept exceptions, maximum percentage for exceptions is 25%. I think this is reflective of the desire to do better, at the same time being careful about not doing disastrously. This is the attempt that we have put in place to maintain the balance in the portfolio. If I like a sector or stock, how much of it should I buy? In many cases, it is defined by regulation. In some cases, it is not. Especially in individual portfolios or even in PMS portfolios or AIF portfolios, alternate investments, it is not so strictly defined. I am saying this because we have seen instances, especially I can give examples of the 99-2000 new economy boom, when 90-95% of the portfolios was only in those ICE sectors, the new economy sectors. That's not balance. So, some people always quote Warren Buffett. Too much of a good thing is wonderful. That's what he has said. But is it wonderful? It's not wonderful for one simple reason. I am no Warren Buffett. And if I'm not Warren Buffett, if I don't have his sagacity, if I don't have his staying power, and if I don't have his, his ability to invest, his Berkshire Hathaway is not subjected to daily NAV movements or periodic quarterly, comparisons. Buffett can afford to do it. I can't afford to do it, so I should not attempt to put 90% in one sector. So what I have done is this. This is the balance that I have chosen to employ. I don't put more than 10% in a single stock. I don't put more than 30% in a single sector. And at all points of time, I try to maintain a minimum of 4 non-correlated sectors in the portfolio. This is again coming to the same thing what Seth Klarman has said. Our desire to be proven right, but the humility to know that we could be wrong. What entry prices do we look at, and what is the method of valuation should we employ? What is the method of analysis should we employ in all companies? Should it be constant? We have seen substantial re-rating in several stocks well beyond what was envisaged. I don't believe that anybody could have predicted, I think this point was mentioned by Sanjoy also in his presentation. Did anybody predict that Page Industries, in 2008, did anybody predict Page Industries is going to go to 45,000 rupees? It was 350 rupees at that time. So, investing with a preset return in mind, I don't think is optimal. I don't think it is necessary, because we cannot predict how much it will grow. But at the same time, if it keeps growing and growing and growing, should we keep holding on in the hope of selling it at the peak? I don't think so. So there should be a balance, and I'll talk about what I attempt to do in pruning the portfolio. And the final thing is, should we subject all businesses to the same norms of valuation? I want to give an example that happened about a year ago. This is one of my portfolio companies. I have this company, boring company called Indraprasth Gas. I don't have to tell the Delhi people about this company. It's well known to everybody. But it's a very, very boring business. And There were a lot of sell calls about a year and a half ago because the EBITDA margin had fallen sharply immediately after the Ukraine war. Let's look at some numbers. See, the EBITDA margin had fallen from about 30% in 2021 to less than 15% in 2023. Now, the important point is the EBITDA margin is not the most important metric in this business. If, for example, you buy gas at 20 rupees per cubic meter and sell it at 25 rupees per cubic meter, what we call a spread is 5 rupees per cubic meter, and the EBITDA margin is 20%. But if you buy gas at 34 rupees and sell it for 40 rupees, your EBITDA margin falls to 15%, but the spread has increased to 6 rupees. Unfortunately, most of the analyst community were focusing on the EBITDA margin percentage as if it was a God-given thing. It is not. The spread has actually increased. And if you see the long-term spreads, quarterly spreads of Indraprastha gas over the last 15 years, they've gone up substantially. This is quarterly numbers where there is more volatility. But if you look at the annual numbers, it's quite impressive. In 2008, it was 4 rupees 74 paisa operating spread per cubic meter. Last year, it was 8 rupees 61 paisa. And it fell in 2023 because of a temporary reason. The reason was that the prices were not revised because of an impending state election in that year. That is a temporary problem. Let's look at what this boring company has achieved over the last many years. In 2013, its revenue was 3,364 crores. Last year it was 14,105 crores. Operating profit was 758 crores in 2013. It grew to 2,039.8 crores last year. Net profit after tax from 354 crores grew to 1,445 crores. The volume sold, million metric standard cubic meter per day, grew from 3.67 to 8.09 in the last 10 years. And the number of geographic areas in which they operated grew from 3 to 21. The March 2023 annual report shows 21 geographic areas. So, two things important in this business are volume growth and maintenance of spread. We have seen that spreads have been maintained. And the number of geographic areas increasing gives us confidence that the volume growth will come. Operating spread has been improved from 5.67 per cubic meter to 6.91 per cubic meter. During this period, don't you think gas prices were raised during this period? How many times gas prices would have been raised? Whether it was the APM gas repricing, or the Ukraine war, or oil prices going up and falling, they have maintained the spread there. It's a beautiful, boring business, but profitable. Why does it happen? Mistakes made when there is no balance in entry price. The primary reason is the desire to outperform. There's nothing wrong with that. The stock market is an epitome of competitiveness. But the desire to outperform always is a problem. If you have a desire to outperform, we look at companies with good prospects. Nothing wrong with that. But when we have a desire to outperform always, we ignore companies that have problems that are strictly temporary. That is where the opportunity comes. I think Sanjoy spoke about this also. In fact, Sanjoy would have spoken about all of my points at some point of time. When there is a mismatch between reality and perception, when perception is much more negative compared to the reality, supported by the facts, that is when we get our opportunity of a good entry price. And if you ignore entry-level valuations and if you buy at prices that clearly are not sustainable, you will pay the price for it. The other thing is about, of course, timing the market. This again, it may be a repeat of one of the slides which Sanjoy did. This is taken from Sanjoy's favorite TV channel, The decade of the 1930s, the overall return of the market was minus 42%. But if we missed the 10 best days, the returns would have been minus 79%. 10 days out of 10 years, that is about 2,500 trading days. We end up by minus 79%. And even in a bullish market, if in 1980s, the market grew by 227%. But the 10 best days, if you missed it, you would have ended up with 108%. And some of the best days happened during bear markets. This is another interesting slide. This is 20-year returns of the S&P 500. Value of $10,000 invested in January 2003 would have risen to $64,000 odd in December 22. But if we just sat out of the 10 best days, it would have fallen to $29,708. And let's look at it. 3 of the 10 best days happened during the bear market. October 13, 2008, bear market. October 28, 2008, bear market. March 24, 2020, COVID bear market. Some of the best days of the stock market happened during the so-called bear markets. When I say average investor, can he or she time it? I am including myself in that list. I am very much an average investor. Professional investing doesn't mean above average investing. It is impossible to time. It is impossible to get that precise date in which we are going to, the market is going to go up. So, I want to focus on one more saying from a great book which has helped me a lot in my investment career. This is David Bremen's Contrarian Investment Strategies. Here also I owe a debt to Sanjoy. When I joined HDFC Asset Management Company, this book was there in the library. And the person who was instrumental in setting up that library is sitting here. This is a very remarkable statement. I want you to ponder over it. One of the most obvious and consistent variables that can be harnessed into a workable investment strategy is the continuous overreaction of man himself to companies he considers to have excellent or mundane prospects. When we are bullish about the prospects of a business or an industry, it is easy to ignore the entry price. It's easy to get carried away. I'll give you one example. Between 2000 and 2006, the earnings growth rate of Infosys was 36% per annum. During that 6-year period, the stock grew 4% per annum. 36% earnings growth between 2000 and 2006. The same Infosys in another 6-year period between 2016 and 2022, the earnings growth was 8% per annum, but the stock grew 21% per annum. What was the difference? In March 2000, the P multiple was close to 100. In 2016, the P multiple was 12.5. Same company. So, the assessment of what the others think about the stock at that time becomes very important. And here I want to quote 2 other great investors. Phil Fisher in his book has said, the conservative investor must be aware of the value of the current financial community appraisal of any industry in which he is interested. We need not follow them, but we should be aware of what they think. And if in our humble opinion, the stock is expensive, the best thing to do is to not do anything at all. Warren Buffett, of course, has been more blunt in saying the same thing. What gives you opportunities is other people doing dumb things. The same thing said in a more, sledgehammer-like manner. We need a balance between participation and staying away. Sometimes the best thing to do is to not do anything at all. I'll give you an example of an IPO which was very, very popular about 2 years ago. The stock listed at about 40 times revenues and at a P multiple of 1,000. Despite enormous enthusiasm during that time, we just sat out of it. We did not participate. And subsequent price movement justified our inaction. But Sanjay spoke about the pitfalls of doing a DCF. But I have observed that a reverse DCF helps us. A reverse DCF, when we equate the fair value to the present market price and arrive at the assumptions behind that value. And if those assumptions seem too outlandish, let's just stay away. We did a reverse DCF of this company's IPO. This is the result. For the 3 years prior to the IPO, the revenues grew at 45% per annum. But the stock needed to grow at 70% per annum for the next 10 years for that price to be justified. Their operating margins for 3 years prior to the IPO was 5%. But they needed to show operating margins of 9.5% for the next 10 years. Clearly, in our opinion, this was not achieved. How do I determine acceptable price? There is no perfect system in this. But I believe we have a good system. And this system has worked for us for the last 20 odd years. So I presume there must be something good about it. What do I do? First of all, we satisfy that the company is not under threat of losing its competitive edge. That is the primary thing. Secondly, valuation at the time of appraisal is compared to its historical average, its own historical average, not the industry average. Because, for example, Hindustan Unilever is also FMCG, Jyoti Laboratories is also FMCG. You cannot take industry average for companies. In my opinion, you have to take the company's own historical average, especially confident that the company's competitive position is not being weakened. We also look at the estimated growth rate in earnings, and which of this we depend on third-party agencies, reputed agencies. The one that we use is the Bloomberg consensus estimate. If 20-25 analysts who are tracking the company for 30 years have put a consensus estimate, I can't do better than that. So I take it as a given and use that estimate for my calculation. If today's valuation is not higher than one standard deviation compared to its historical average, or if it is not higher than the estimated growth rate in earnings, the stock will buy. Provided, of course, the other parameters which we discussed in the previous slide are valid. If it goes beyond 2 standard deviations, I begin to sell. I don't sell in one shot, I begin to prune. And as I told you, I found the reverse DCF model of Michael Mauboussin very useful in coming to a conclusion whether the assumptions are outlandish or not. Maintaining a balance between growth and stability. I deliberately keep some stocks in my portfolio where I know that the earnings growth will not be very robust. But I am expecting these companies to fall less when the market corrects sharply. Deliberately. I've seen several portfolio managers overload on stocks where there are maximum growth opportunities. I don't think that is necessary. It is important that we don't know when the next tsunami is going to come. And we have to build a house that is strong enough to withstand that tsunami whenever it comes. So instead of trying to predict when the tsunami will come, I will focus on building a portfolio which will be less affected. Of course, this will also be affected if the tsunami does come. Some companies where the level of expectations are low, some companies where the threat of obsolescence is low, even if the earnings growth is not so great as compared to other companies. Deliberately, I keep a balance like this. I'll give you again some examples. In 99-2000, about 95% of some portfolios were in those ICE sectors, new economy sectors. In 2007, most of the companies invested were in the real estate, infrastructure, power, and related sectors. In 2017-18, I've seen portfolios with 45-50% in NBFCs and housing finance companies. This imbalance is dangerous, in my opinion. And these defenses provide the cushion when the inevitable slump comes. We can't predict when it will come, but we should be prepared for it. How long do we hold on? And here we need a balance between idealism that our investment process is the best and the pragmatism that we may not be. So what do? I will wait for 3 years. That is the method that I have devised for myself. For 3 years, if the stock doesn't move and if there is no significant improvement in the fundamentals, both these conditions are important. Even if there is no deterioration in the fundamentals, if there is no significant measurable improvement in the fundamentals and the stock doesn't move for 3 years, I will replace it. Because, as I said, I'm fortunate to get a set of clients who are patient, but their patience is not without limit. Balance between large, mid, and small caps. See, these are all cyclical. In 2000 March, period ending March 2008, small caps did much better than the large cap index, about 8% higher per annum for a 5-year period. But the period ending March 13, the thing was reversed. Large caps did much better than small caps. Again, it reversed in period ending March 2018. And in the period ending March 2023, again large caps did better than small caps. But now again small caps have done better than large caps. So, taken over a 20-year period, small caps have given about 18.98%, large caps have given about 15.91%. About 3% difference over a 20-year period the small cap index has given, assuming that our stock picking skills are as good as this. But the drawdowns is much higher in a small cap. Small caps have had a maximum drawdown of 79%, whereas the Sensex has had a drawdown of 60%. So if you are willing to withstand that drawdown, you are justified in hoping for a 3% higher return. But we have to be satisfied that our clients are willing to withstand that drawdown. Many of them may not be. Which is why there should always be a proper balance between mid, large and small cap. And that balance will differ from person to person. Incidentally, if you replace this March with September, the results are quite different. If you want those details, I can read them out to you. The September 5-year returns, for instance, large cap index has grown 2.69%. Where is that? That 12.34 has become 12.69, but the 9.67 has become 21.09.
Wow.
What's the ultimate balance we want to seek in a portfolio? We want to buy good businesses. We don't want to overpay for it. Which means that we can buy them only when they are not too popular. When something is popular, it reflects in the valuation. And when the valuation is, in our opinion, too expensive, best thing is to stay away. Which means that we have to buy them when there are apprehensions or doubts or fears about their immediate future. Only then you get a good company at a decent price. If you are willing to have a longer time horizon, that is when you get a good company at a decent price and ignore the possibility of short-term underperformance. So long as we are satisfied that there is nothing wrong with the ability of the company to compete effectively, a short-term setback provides a balance between a good business and a good price, which means that our time horizon necessarily needs to be long in following this sort of investment style. Let's assess the environment under which we are operating. Can we really outguess or out-analyze everybody else? I don't think so. All portfolio managers today come from very reputed business schools. All their educational qualifications are very similar. All of them have modern computerized databases. All of them have data at their fingertips. Right? Each of us has access to the same information, and the internet has made information availability so easy. It's so much so that today the problem is not of lack of information, the problem is too much information. Cutting out the noise becomes far more important than seeking information. We compete against giant institutions with enormous resources for research and talent. So therefore, the only way, and this is my submission, the only way we can distinguish ourselves is to have a difference in time horizon and or by being first. By following the crowd, you can't beat the crowd. I again quote David Freeman. This guy has had a big impact on my thinking. Respect the difficulty of working with the mass of information. Few of us can do it successfully. In-depth information does not translate to in-depth knowledge. I am saying this because I have seen several people who go to ridiculous extents of trying to find out everything about the company before they invest a single rupee. It is not necessary. It is not possible. Just look at the 4 or 5 factors which we consider important for ourselves. You know, this thing is, I don't think it's about shooting a target. It is about shooting a moving target. You don't aim where the target is. You aim where the target you expect to be when the bullet reaches there. Conclusion. You know, what am I concluding with? Is the company, these are the essential factors we should consider. Is the company capable of maintaining or improving its competitive position? This is, in my opinion, the most important job of an investor. Is the company retaining its ability to grow its earnings and cash flows sustainably? Is the company run by people whose interests are aligned to that of the minority shareholders? And finally, is the stock available at a level that gives us confidence that the expectations around it are not unreasonable? Why does the stock price go up? You know, maybe a silly question to this audience. Like, we can give hundreds of reasons, but a stock price goes up only for one reason. Carefully think about it. Because there is an enhanced level of expectation about that company's future performance or that stock's future performance. And a stock falls only because some expectation has not been met. So it is my submission, ladies and gentlemen, that we restrict our choices to companies where the level of expectation is not too high to begin with. And within that, choose companies which have the ability to compete. The set may be small and we may have frustrations in finding companies all the time. But we do get opportunities. You know, in 99, 2000, when new economy was booming, Nestle was available for a market cap of 3,000 rupees. Procter & Gamble was cheap. You know, almost all the so-called old economy companies were cheap. Many of the banks were available for dividend yields of 10%. In 2007, when the Reliance Group was booming, when infrastructure, Unitech and DLF were booming, GlaxoSmithKline was cheap. Hindustan Unilever was available at 4.5% dividend. 2 years ago, ITC was cheap. Public sector was cheap. Industrials were cheap. Even today, there are several which are cheap.
Sundaram, give us the list.
And we balance it with the internal factors to consider. It is said that the first step in any journey is to understand where we stand. So investing is not just about studying companies and industries, it's also about studying ourselves. And this is highly individual. We should find out what our time horizon is. We should find out, you know, how strong we are in withstanding volatility. Even if the stock is good, what should be the size in our portfolio? What is our attitude towards temporary underperformance? And controlling the intolerance towards someone else making more money than us. This we should finalize before embarking upon an investment program. So my submission, ladies and gentlemen, is that let's balance the external factors with the internal factors. Let's balance the size of each company in the portfolio. Let's balance the sectors we choose to invest in the portfolio, and let's balance the price at which we intend to buy into any company. I want to conclude by, nowadays, Sanjoy said, I'm also approaching senility. So I've written this whole thing in the form of verse. I want to read it out to you, just as a conclusion. Important learnings from 30 years I wish to share. Almost all of them have accompanied the visit of the bear. The lessons he teaches are like a scar from a burn. But he is not the cause. It is our quest for the highest return. Clients whose wealth needs a lot of upkeep. It is not sky-high returns they seek, but a peaceful night's sleep. Almost always they seek the avoidance of major flaws, and they are happy with a decent return without a permanent loss. During such times when we are driven by greed, it's easy to forget that a flower is outgrown by a weed. When companies strictly also run so fast, it is a sure sign that the party won't last. Of all the traps, let's be wary of the inveigle. It is time to be careful when someone claims to soar like an eagle. The truth usually is they are not much bigger than a crow. The lesson, let's not expect any company to be much better than what they have to show. The government may be stronger with a larger number, but in the stock market, facts matter more. Let's always remember. An investor would do well to ignore the tripe, and that increases proportionately with increasing height. There are people here whom we see rise to the top with just speed. But as the saying goes, the market is like a Ferris wheel. When we begin to think that something has a following en masse, it's really when we should remind ourselves, this too shall pass. Since days of old, we have been taught of the yin and yang. These are better for the portfolio much more than a big bang. A bull market tempts us to act with nonchalance. In the end, what matters really is a good balance. Thank you for a patient hearing.
I mean, that's where the real learning happens. So, and at the same time, you're saying it is not the bear market, but it is our quest for highest returns, which is our undoing. So, can you please elaborate on that?
I'll explain with an example. This is when we were beginning our career as portfolio manager. This is the early 90s. We were in a company called Widget Silsuri Mutual Fund, which eventually became Zurich Mutual Fund. My colleagues at that time were very people who became extremely famous and eminent in their own right. We invested a lot of money in what was at that time the IPO. So all these yarn which I spoke about did not come in one day. It's a result of the hard knocks I faced as an investor. At that time, it was the easiest thing to do is to get firm allotment in an IPO, wait for the listing and sell on listing with the 20-30% return and feel like a genius. It went on well for some time. But then we were stuck with extremely illiquid and extremely poor quality businesses, which we consciously took a decision after that. Two decisions. One is we will not wait for better time. We will bite the bullet and clean up the portfolio even if it meets a lot of pain. It took us 2 years to pay that. The lesson which has been seared in my thinking after that is never follow the hype. Hype is dangerous. And hype is reflected in the high valuations of any company or any sector. When it is hyped up beyond, and I define hype as valuation of today, which is much more higher than its historical average valuation. If that is the case, we will not participate. That is the lesson. That's an important lesson. And unfortunately, we learned it at somebody else's expense, but it has stayed with me ever since.
So, I mean, tell us about those early years. I mean, you started in 1989, and I think this was happening in mid-90s.
It was a time when, after the Harshad Mehta boom, 92, from 94 to 96, I think there was this, what I call the IPO boom. Huge number of companies, many of them pretty dubious, came out with publications and all of them listed at 30%. Some of them were good, I'm not saying no, but some of them were not. You singed by that experience. And I think that learning has stayed with me ever since. So to answer your question, it was definitely our desire to outperform at all points of time and beat everybody else made us take that risk which was not necessary to be taken in those days. And subsequent bull markets have stayed away from that. So that has been an important learning.
Okay. And in the same poem, you also said, during such times when we are driven by greed, it's easy to forget that a flower is outgrown by a weed. When companies strictly also run so fast, it's a sure sign that the party won't last. Though we will concentrate on what you spoke today, but just as a comment, do you see the current environment, especially in small caps?
Some examples of previous years. In the technology boom, really it started, I think, in 96 or 97. That was the time it really started. The first companies that did well were Infosys, Wipro, companies like that. TCS wasn't listed at that time. Then Infosys started growing at a mere 50%. Then there were others like Satyam and IAIP which took their place. And towards the end of the bull run in technology, TSQ Software and Silverline Technologies and Prita Media Graphics, all these guys vastly outperformed Infosys.
Okay.
You see the 2007 infrastructure boom. The ABB and Siemens and these companies did well in the beginning. Then there was the second run company, then the third and the fourth. With the fourth run companies do much better, grow robustly, much more than in terms of stock prices. You grow much more than the more established businesses. It's a warning sign. That's the limited point I'm making. So let's focus on the balance sheet of the company, let's focus on the cash flow, let's focus on the track record. Let's not just focus on the stock price movement.
Yeah. So my question was, in the current environment, do you see some of that happening, especially in the small cap space?
See, in any bull market, there are always companies of that kind. I am not going to draw me into naming them. But yes, there are some companies I will be wary of.
All right. Coming back to the discussion we had, or rather the session you took, you are a contrarian, and at times when you take a contrarian position, at times initially you're always in doubt, or at times when the market moves against you, you are in doubt. So what are some psychological hacks or behavioral science that you use to determine, and in those times when market is going against you, whether you should stick to your position or you should change?
I think there is a misunderstanding of the term contrarian investor. A contrarian investor is not somebody who goes west when everybody is going east. I think a true contrarian investor waits for the hype to totally die down. People should forget that company exists. That is when you should look at that company. So it is not as if, at the first sign of trouble, at the first sign of fall in the stock price, I will look at a company. I will buy it after it has substantially fallen. And when people are, almost given up on it. Not every time we get opportunity like that, but when we get an opportunity, we should buy big. So, contrarian investing is not about being different for its own sake. Contrarian investing is about choosing good quality businesses that others have chosen to ignore. That is contrarian investing. And about your second question, of course, there will be some times when it will be frustrating. But what gives us a strength during that time is the confidence that we have in the company's ability to compete. We never choose a company that is incapable of competing, at least consciously no. So, if it doesn't perform this quarter, has it done well in terms of its operating parameters? Has it done well in terms of its profit margin? Has it done well in terms of its cash flows? The stock price will follow. If it doesn't follow immediately, it will follow after a while. It doesn't matter. And third point is, it is not my ambition to be right all the time. I don't think I can be. If I am right in, if I pick 10 stocks, if I am right in 7 of them, I think the client will have a decent result. 2 or 3 are going to go bad. I don't think, not even Warren Buffett has that track record. So, 7 out of 10 is what I attempt to do. 6 out of 10 gives a good result, 7 out of 10 gives a pretty decent result. So, there will be 1 or 2 that doesn't go our way.
Couple of related questions. So you do mention that from time to time you will revisit those businesses, your thesis, whether the fundamentals are intact or improving, and only then you will continue. Now, at times, you also mentioned of a time stop loss. Can you give us maybe an example, I don't know, with the name or without the name, where that time stop loss has been hit and you have exited?
The latest example is, I have held Sanofi for a long time. I bought it because I think that anti-diabetes medication is a long-term growth business in this country. And Sanofi is one of the important manufacturers. And we were also, we were ignored by the health ministry study which said that 13.8% of the adult population in India has high blood sugar levels. And that's a company that has rewarded shareholders with in the past. So we bought Sanofi, but for 3 years it did not move. And there were, price controls which were imposed by the government, which was tapped up. I would have held on to Sanofi, some other opportunity did not come its way. Always the portfolio is, I have to evaluate if I get a new opportunity which was not there earlier, I have to evaluate it against the weakest link in place portfolio. So something that was not available to me earlier suddenly became available. And we thought it was a superior opportunity, so we switched from Sanofi to that company. Thankfully, it has worked out. I also use this opportunity to spend some time on discussing when I will sell it. I gave a lot of points about what are the kind of shares I buy. I also have to tell you when I will sell it. If the basic assumption with which the stock was bought in the first place becomes invalid, then I will sell it, irrespective of whether I am making a profit or a loss. But thankfully, this has been a very infrequent occurrence in my life. The most common reason to sell a share is because the price is appreciated more than what we think it is worth.
High expectations.
The price is substantially appreciated, in which case I will again make move. The third reason is some opportunity that was not there earlier becomes available now, and it is superior to the stocks that I hold in the portfolio, in my judgment.
Right.
I may buy company A because company B, which is in the same industry, is expensive. But several months later, company B may become very cheap, or company A may become expensive. And if they are of comparable quality, I don't mind switching from A to B, but I'll take care that I don't do it more often. I have to keep the overall churn rate also. And the fourth reason I said is when the client wants either a full or a partial return, in which case I have to sell. So if these conditions are not met, we are happy holding on for months and maybe years together. There have been stocks which I have held for more than a decade.
Right. And in your talk, you also mentioned that you deliberately keep companies which may not grow much, but which are robust, and hence the downside in a bear market is low. When you select such companies, I mean, we all know about value traps, companies where we think there is value and then they go nowhere. How do you avoid value traps in those situations?
Repeat the point I said earlier. If we choose a business that is, in our judgment, is capable of competing, and we are confident that we are not overpaying for it. Plus, of course, we are confident that the management has not gone grossly against minority shareholders' interests. If we are right in 7 cases out of 10, I think we have a decent result. 10 out of 10 is not something that I can. There will always be 1 or 2 that will miss. But I again want to stress on the definition of value investing. I am not looking for simply single-digit P multiple or low price to book value. That is not how I define value investing. Value investing is buying a quality business for less than what it is worth. And I define what it's worth as, comparison to its historical average, valuation compared to today's valuation. If something has been trading at 25 P multiple for the last 10 years, if it comes to 20 today, I would consider it cheap. I can't expect to get a company of that kind at a single-digit P multiple.
Correct.
It's maybe I'll get it in once in a decade kind of bear market, but I can't expect that to happen every now and then. No, it happened in 2008, it happened in 2020, but that's not a bear market I don't really want to see next.
Right. And a related question which I got from the audience, I mean, from time to time you would have experienced that the portfolio is underperforming the markets, indices. Now you mentioned about investors not wanting high returns, but then you need to have the right investors, right? So there is a question from the audience which says, how do you select your investors? One of the biggest issues in managing public money is to find the right balance between expectations of the investor and the fund manager.
See, what we do is we go to pretty great lengths in explaining to the investor what he or she can expect to get from a portfolio like ours. And they are pretty upfront about it. And if the client has seen that what we do is the same as what we said we would do, the client by and large agrees. Of course, there are some circumstances where the client has a need for the money, or maybe they are reinvesting in their business, or they want to buy some property, or something like that. But thankfully, touch wood, there have not been any clients who have been dissatisfied with the way we are managing money and pulled over for that reason. There are other reasons like investing in property or investing in their own business and so on and so forth. But nothing because they are dissatisfied. And it's not that we are not underperformed. We have underperformed the market periodically, and everybody underperforms. But it's important to say what you will do, what you intend to do, and stick exactly to that. And periodically keep reiterating that you are indeed doing that. I think that is what is a reinforcement which is needed for a client.
Okay. And you mentioned, and Sanjoy sir in his presentation also mentioned about temperament, the internal factor being one of the most important. Do you think temperament is something which is innate in an investor, or it can be learned and cultivated?
I think temperament is a function of various things. It is a function of the experiences you have as an investor. It is a function of, especially the bad experience you have, that really stays with you. It is a function of the kind of people you interact with, especially as you consciously interact with people who agree with you, and then you compare your thought process to theirs. It is a function of the mistakes you made as an investor and the observation of mistakes you see others make. I think it evolves with time. Nobody is born with a great temperament and investors who are. I don't think anybody is a great investor right from birth. You acquire that over a period of time, and you keep refining it over a period of time. So I think that temperament is individual. Temperament is refined and evolves over a period of time.
Thank you so much. Thank you.